There's still a lot to distract investors. Brexit is still not done, and we still don't know exactly what will happen on October the 31st. Talks to resolve the US-China trade war look promising, but that could change at any minute. And global growth forecasts are at their gloomiest since the financial crisis. And all this before we even broach the subject of impeachment. How should investors respond to all this upheaval? Volatile times call for cool heads.
We will be leaving the EU.
America is winning again.
Today, we decided to lower interest rates.
Do not raise this time.
Hello and welcome to Cool Heads, the show that cuts through political noise to focus on what matters most to investors. In a moment, I'll be speaking with veteran investor Bill McQuaker. But first, I'm joined by portfolio manager Charlotte Harrington. Hi, Charlotte.
Hi.
So it feels like there's a lot of geopolitical uncertainty at the moment, but in objective terms, is that really the case?
Well, if we look at something like this Global Economic Policy Uncertainty Index, we can see right from the start of this chart that this line's been creeping higher and higher, and the most recent move higher around Brexit and trade wars is relatively pronounced.
Okay, so it does feel like the uncertainty is real. What's the implication of that for the financial markets?
I think particularly for corporates, that means they might hold back a bit on investment, perhaps invest in different parts of the world, and that uncertainty sort of depresses overall investment.
Okay, Charlotte, thank you very much indeed. So, Bill, that sounds like quite an uncertain environment. How does it compare with the ups and downs of the cycle, the uncertainties that you've experienced in the past?
I think there's no question that this is an uncertain period for the global economy. But from a market's perspective, I think the environment we're in at the moment isn't quite as extreme as we've seen at previous points of maximum uncertainty. If I compare today with the Italy joining the Eurozone debt crisis, the global financial crisis, 9/11, dot-com bust, each of those had more of a shock factor than current circumstances do.
Okay, well, let's zoom in on the biggest concern, I guess, at the moment, which is the trade tensions between the US and China. Let's assume that we don't get a swift resolution of that. How does that feed through into assets, winners and losers over the next year or so, do you think?
I think a wholesale resolution of that dispute is quite unlikely between now and the US general election in November next year. But that doesn't mean we can't have a truce. And I think it is shaping up like there's a better chance of a truce before the year is out than we've seen at any point until now.
And the winners and the losers in that situation?
Should that happen, then I think that, along with a couple of other developments, could actually change the landscape a little bit for markets. This year has been characterised by quite a sense of fear and quite a sense of risk aversion. And there are parts of the asset market mix that are quite lowly priced, as cheap today as they were in the first part of 2016. And it could be that circumstances fall into place that give them a bit of a tailwind as we approach the end of the year. And that'd be things like European equities, maybe even European banks, Japanese banks, things that people have fought shy of for much of this year.
Well, let's focus in on one of those cheap markets, which might be the UK. Clearly a lot of uncertainty in the UK market associated with Brexit. How do you see that changing, and is the UK an opportunity?
Well, that's another one of those developments that might fall into place. And there's been so many twists and turns with Brexit. We're getting closer to an agreement, though, than at any point in the 2 or 3 years we've been talking with the Europeans. And I think there is a decent chance that by the end of this month, we've agreed an orderly arrangement that sees the UK leave the EU, but the transition period kicking in and creating a bit more sense of certainty in the UK economy that would be good for domestic companies, that I think would probably be good for the pound, although it's already moved a fair way, and would be good for the health of the UK in the eyes of international investors. And we may see a budget that's quite pro-growth as well as a cherry on the cake.
Okay, so if you're looking to protect your portfolio from the high levels of geopolitical uncertainty, how might you do that? Cash, I guess, but are there other things?
There's a raft of different investments that people could reach for. The US dollar, the Japanese yen are traditionally quite safe havens. Government bonds, the same. But those assets, particularly government bonds, have actually run a very long way, and I think are priced for this uncertainty to continue. An asset that is not so highly valued and would have scope to run further if things deteriorate again is gold. It's quite an interesting asset. I think it's one of the few things that one can purchase that plays to both a deflationary global environment and an inflationary global environment. Now, the setup of markets this year has been intense concern about a more deflationary wind blowing in, and gold has performed quite well.
So gold, a hedge against both bad things in both directions, maybe.
That would be one way of summing it up.
Bill,
yes.
Thank you very much indeed. Many thanks to today's cool heads, Charlotte Harrington and Bill McQuaker. In our next show, we'll take a closer look at sterling, the chief barometer of Brexit. See you then. Goodbye.